Hey, good afternoon, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Hump Day, Wednesday, February 20th, and we got a couple economic news releases scheduled for today. Today's going to be a volatile day as we have the first item here, the producer price index. This is the inflationary numbers for the wholesale level for the month of January. We had a negative back in December, and this month they're projecting 0.4% growth, and it came in at 0.2, so a little bit shorter than what the forecasts were. But once you go into strip out the food and energy from the producer price index, which is the volatility that can fluctuate quite a bit, you get the core, and this is really what we kind of really look at is the core. So we had a 0.1% back in December. We thought it'd come up to about 0.2. And it came in what we had forecast-wise. So still pretty moderate, still in control. And then we also had the housing starts for the month of January. So back in December, we had 973,000 homes being created, and we figured it would slow down a little bit in January to 914, and it came in at 890. So lower than expectations there. So this is something we have to keep an eye on. We want to see if it's in line with the weather, if this is due to the weather, or perhaps, as we saw on Tuesday, we had the builders index kind of decrease a little bit. So are they feeling that maybe they're going to pull back on new homes, or are they is it due to the weather? Now the forecasts are projected that this could be a strong part of our economy going forward. So again, this is something to keep an eye on, see how things progress. And then today, about 11:15, we had the at Pacific Standard Time, we had the Fed minutes released from their meeting back on January 30th. And here's a couple of the highlights of that of the minutes, kind of like the Cliff's Notes, as you will. Employment had continued to expand at a moderate pace, but the unemployment rate remained unelevated. Members saw the economic outlook as relatively changed since the previous meeting. The committee agreed that it would be appropriate to continue purchase of mortgage-backed securities at a pace of $40 billion per month and purchase of longer-term Treasury securities at a pace of $45 billion per month, as well as to maintain the committee's reinvestment policies. The committee also retained its forward guidance about the federal funds rate, which including the thresholds on the unemployment and inflationary rates. Some members remarked favorably on the move away from providing calendar dates in the forward guidance and toward highlighting the economic conditionality of future monetary policy. So in kind of short, this was kind of in line. There really was no surprises in this. The one probably piece of news I think they're going to kind of like is that they're not putting a specific date as to when they're going to eliminate these mortgage-backed securities. They're just going to kind of keep looking at where the economics, where things are moving. Are we seeing improvement in the unemployment? Are we seeing high inflation coming up? They're going to be keeping an eye on those rather than just specifying a date. So that seems to be more favorable. So we'll go ahead and take a look at the bond market, see what interest rates are doing right now. Oops, I'm sorry. Actually, the stock market's down, so that's really about the only thing that came up on the headline news. My apologies. So let's go ahead and take a look at the stock market, or our bond market rather, and as we saw, we were actually up a little bit during the day, and when the minutes came out, we bounced downwards, and now we're kind of up about 3 basis points. So we're kind of in line where we left off yesterday, so there's really no change where we left off after the day of yesterday. Now, something to note, keep an eye on the S&P 500. We're starting to reach at their all-time heights, and the last couple times they've reached that, it's been a very strong ceiling. And once they reach that, a lot of times it drops very quickly. And if that happens, we could see a nice improvement in our interest rates. So what that means is S&P basically holds 80% of the money that's out there, and a lot of that money is going to go back into mortgage-backed securities as a flight to safety. As a result, when the bond market, as you see on this graph here, goes up, the interest rates will improve. So look forward to seeing that probably in the near future. As to specific time frame, we can't really project on that, as we're still kind of waiting on the stock market to go through its 10% correction. It's one of the longest periods of time we've experienced without going through its normal progression of a 10% correction. So keep an eye on that. All right, folks, so interest rates are about the same as where we left off yesterday. Thanks for watching. Hope you guys have a wonderful day, and we will see you guys tomorrow. If you'd like to receive these on a daily basis, just stop by Mike'sDailyMarketReport.com. In the upper right-hand corner, you'll see a feed burner where you could subscribe. We don't share information, and these are only items you'll receive from us are these videos. Have a wonderful day.